Hello, Assalamualaikum. My name is Luqman Hakim Muhammad. My student number is 2019440882 and I'm from class TIC 1104AA. Okay, today I will be presenting the rest of type of risk in investment, which are risk of inflation, risk of horizon, risk of longevity, and the last one is risk of foreign investment. So here we go. The first one is risk of inflation. Inflation is a situation of rising prices in the economy. Inflation is described as an increase in the cost of living caused by an increase in the price of goods and services. Inflation risk is the risk that inflation may harm the profitability of an investment, the valuation of an asset, or the buying power of a stream of revenue. Physical asset and equity are less susceptible to inflationary risk and can benefit from unexpected inflation. Bonds are often seen as a most vulnerable investment to inflationary risk by investors. Okay, the next one is risk of horizon. Horizon risk refers to the possibility that investment horizon may be abruptly shortened. For example, imagine someone lost his job or his house, so he needs to replace right away, and during the period of time to get a new job, he needs money to continue his life. So he requires and needs to sell his portfolio to get the money. So if at the time he sell the portfolio, market decline, so he will losing his money. To overcome this horizon risk, he can diversify his portfolio by including some short-term investments. This way can minimize his losses when he needs to sell the portfolio. Okay, next is longevity risk. Longevity risk refers to the chance that life expectancies and actual survival rates exceed expectations or pricing assumptions, resulting in greater than anticipated cash flow needs on the part of insurance companies or pension funds. The risk exists because of rising life expectancy rates among policyholders and pensioners, as well as an increasing number of people approaching retirement age. The nature of longevity risk is because individuals are now enjoying longer life as a result of multiple causes such as technological advance in medicine and healthcare. The last one, risk of foreign investment. For example, if an American company invests in an Indian company, so this called as foreign investment or international investment. So for investor, actually he needs to face with three risks when he invests in foreign market. The first one is transaction cost. The added interest expense remains the most significant challenge to investment in foreign market. The second risk for investor who invest abroad is currency volatility. When an investor invests abroad, he must convert the type of currency of his country to the country in which he is investing at the current exchange rate. For example, when an investor wants to make a currency exchange and then the value of the currency is low, he will face a loss. And the third risk that investor from abroad has to face is liquidity risk. This is the consequence of not being able to sell an investment easily and without incurring significant damage as a result of a political or economic downturn. Since the money is coming from over the border, more laws and regulation must be applied to international investment. Alright, for conclusion, an investor cannot avoid from the risk in investment, but there are several ways that the investor can use to reduce the impact of risk on their investment. Among them are diversification. Okay, so what's the diversification? Diversification is a portfolio risk management strategy to reduce the overall risk of the investment, which combines a variety of investments within a portfolio. The second one is do research, and it is important for an investor to have a good knowledge because Warren Buffett had once said that the risk comes from not knowing what you are doing. An investor must do thorough research and should have adequate knowledge about the business before investing in any company. The third one is risk tolerance. Risk tolerance should be defined well in advance before making an investment decision. Affordability, ability, and willingness to take risk from the overall risk profile of the investor. The next is an investor must have an exit plan. An investor needs to know how to overcome or reduce losses in an investment and what action need to be taken. This is very important to save money that has been invested at a loss. And the last one is to prevent from risk in investment. The investor can invest in risk-free government bonds. It would be ideal for the investor to invest in risk-free government-backed securities to avoid any capital erosion. The returns are comparative lesser in such securities. That's all from me. Thank you for watching and Assalamualaikum.